Welcome to my channel. It's me, Assad, again. So we've got here a case study, which is Grognak, the Butcher's Book. And now I'm identifying the first economic event before making any accounting entries. So in this story, Grognak begins the business with two resources. First, he contributes 40 loots in cash. So second, he contributes a great axe that is valued at 15 loot. Here it is. Yep. And both of these resources become assets of the business because they will be used in the company's operations. And since Grognak is the owner, these resources represent the owner's investment into the company. So economically, that is happening here. What is happening here is that the business receives assets from the owner, and the owner's equity in the business increases by the same total value. Now I will create the journal entry for this transaction, having first the business receives 40 loot in cash. So it's 40. Next we have cash is an asset, and assets increase with debits. So I debit cash for 40, and the next business receives what? A great axe that will be used in operations. Great. And we would mark it as equipment. And this represents equipment for the business, which is also an asset. Assets increase with debits. So I debit equipment, debit equipment for 15. Great. Now I'll calculate the total value of the assets contributed by the owner. Here we have 40 plus 15 to the part of owner capital. Having plus 15, we've got 55. So because these assets come from the owner's equity increases by the same total amount. Equity increases with credits, so I credit owner's capital for 55. This keeps the journal entry balanced, so because the total debits equal total credits. Certain accuracy, I decided to change here a little bit. It should have been CR owner capital, and this whole thing is accounts. Whereas here it is debit, and here we've got credit. It's all being black, and so it should be in here actually. So now I will post the first debit from the journal entry to the ledger, meaning to the T account. So we'll go to the account. Let me make it bigger. We've got cash. So what we do here, the journal entry shows a debit of 40 to cash. So cash in is asset account, and the debit increases the asset. So record 40 on the debit side of the cash T account. Great. Next, I post the debit to equipment. Basically, we do the same thing. The journal entry shows that equipment increases by 15. So we got it. Equipment is also an asset account, and assets increase with debits. So I record 15 on the debit side of the equipment account. Finally, I post the credit to the owner capital. We do the same thing. The journal entry shows a credit of 55 to owner capital. Done. Owner capital is an equity account, and equity increases with credits. So I record 55 on the credit side of the owner capital account. All right, I made a little bit of change here on the side of this heading account, debit, credit, just to make it more clear. So now I will identify the second transaction before recording any account entry. In this transaction, Grognak receives 80 loot from Ferndale's production arrangement. So in exchange for providing protection services, because the company receives cash, the business gains an asset. At the same time, the business earns revenue by providing a service to the customer. So economically, the company receives cash and earns service revenue. Now I will record the journal entry for the second transaction. So in this transaction, the company receives 80 loot from customers in exchange for protection services, right? So we've got another cash, which is 80, and we've got the company receives 80 loot from customers in exchange for protection services. And because the business receives cash, the cash account increases. So cash is an asset, and assets increase with debits. So I debit cash for 80, making it revenue. At the same time, the business earns revenue by providing a service. So revenue increases the company's equity, and equity increases with credits. It's going to be also 80. So credit revenue for 80. This keeps the journal entry sort of balanced because the total debit and the total credits are both 80. Now I'll post the second transaction to the cash account. So the journal entry shows another debit of 80 to cash. Because this account already has a debit of 40 from first transaction. I add the new debit to the existing balance. So let's do this way. Yes. Choose this one. Great. And so the cash account has now has a total debit of 120. So next I post the credit portion of the transaction. The journal entry shows a credit of 80, right? To revenue. Revenue increases equity, and equity increases with credits. Let's put it this way. Great. So I record 80 on the credit side of the revenue account. So the ledger accumulates all activity for each account. Now the second transaction has been posted to the ledger. The cash account increased again because the business reviewed additional cash from the customer. So the revenue account shows a great credit of 80 because the company earned revenue So by providing services, right? This completes the posting of the second transaction. So now I will identify the third transaction before creating the journal entry again. In this transaction, the merchant guild pays, he pays 120 loot from the merchant guild of Orvest, covering 3 months of exclusive protection. The company receives cash immediately, which increases the cash asset. So, however, the services will be provided in the future, so the revenue has not been earned yet. Because the business still owes services to the customer, creating a liability called deferred revenue. So, again, economically, the company receives cash now, but records a liability because the service obligation still exists. Now I record the journal entry for the third transaction. The company receives 120 loot from the merchant guild because the business receives cash. The cash account increases. Cash is an asset, and assets increase with debits. So I debit cash for 120. Here we have this debit, and however, these services have not been provided yet. Of course, since the business still owes protection services to the customer, this creates a liability. This liability is called deferred revenue. Liabilities increase with credits. So I credit deferred revenue for 120. This keeps the journal entry balanced because the debit and the credit are both 120. Next, I post the credit portion of the transaction. The journal entry shows a credit of 120. So to deferred revenue. Or deferred revenue is a liability account because the business still owes services to the customer. Liabilities increase with credits. So I record 120 for the credit side of the deferred revenue account. Now I post the debit portion of the third transaction to the cash account. So the journal entry shows a debit of 120 in cash, right? Because cash already has previous debits from earlier transactions. And I add the new debit to the existing balance. So the cash account, it will be added, the new one. So now it shows a total debit of 240. Now the third transaction has been posted to the ledger. The cash account increased again because the business received additional cash. However, this company has not yet provided the service, so the amount is recorded as deferred revenue, which is a liability. This means the business still owes services to the customer in the future. Now I identify the fourth transaction before recording the accounting entry. In this transaction, the company purchases a war drum for 45 loot. For the war, right? It paid in cash. How do we know? Here is any other types of money paid methods. So we would assume as a default that it's cash. And what else? So who purchased it? Yeah, Grognak. Multiplier. Drum as moral infrastructure category, long-term strategic asset. Great. The case study describes the wardrobe as a capital asset. A capital asset is something the business will use in its operations for a long period of time. Because it will be used to operate the business, it's recorded as equipment, which is an asset. At the same time, the company pays cash. Yeah, which reduces the cash asset. So economically, one asset increases and another asset decreases. So we came to the point of forced transaction finally. The company acquires a wardrobe that will be used for an extended period, right? Because it provides value for multiple periods. It is recorded as equipment. Rather than just expense. Equipment is an asset, and assets increase with debits. So I debit equipment for 45, right? And the company pays for the drum, which basically removes trash, reduces trash. So cash is also an asset, and when assets decrease, they credited. So putting cash as credit. So I'm putting cash, credit cash for 45. Yeah, let's see. Cleaning the journal again, balanced, because the debit and credit tab was 45. So posting the debit portion of the forced transaction to the ledger, the journal entry shows a debit of 45. So to equipment, because equipment already had a debit of 15 from previous existing balance. So I'm adding a new one to the existing balance, making it this way. That's 45. Great. So the equipment account now shows a total debit of balance 60. So the next we've got credit version of the transaction. The journal entry shows a credit of 45. Yeah. And cashing is an asset account. When an asset decreases, it's recorded with a credit. So I record 45 for the credit part. Transaction represents an asset exchange. The company increased its equipment asset while reducing cash, and no revenue or liability is created in this transaction. Identifying the fifth transaction before recording the journal. In this transition, the business provides protection services to the Mr. who is Thornwick, just like John Wick. And it is valued at 60 loot. However, the customer doesn't pay immediately and instead promises to pay later, after 6 weeks, as they say. Because the service has already been provided, the company earns revenue, right? At the same time, the company now has the right to receive payment in the future. This creates an asset called accounts receivable, which represents money owed to the business by a customer. So customers owes money. Now recording the journal entry for the 5th transaction. What do we have, guys? The company provides protection services valued at 60 loot, right? So we get accounts receivable, right, at 60 loot. Great. The service has already been performed, so the company earns revenue, revenue increases equity, and equity increases with credits. Where is credits? So credit revenue for 60 also, which is revenue. Great. They promise to pay later, right? Because the business now has the right to receive money in the future. It requires accounts receivable. Accounts receivable is an asset, and assets increase with debits. So I debit accounts receivable for 60. I post the debit portion of the fees transaction to the ledger. The journal entry shows a debit of 60 to accounts receivable, right? Great. Accounts receivable represents money owed to the business by customers. So it's an asset account. Assets increase with debits. So I record 60 on the debit side of the accounts receivable account. Great. Now we move on to the credit portion of the transaction, which is clear. We've got the revenue of 80, right? So the journal entry shows an additional credit of 60 to revenue. Revenue already had a credit balance from an earlier transactions, so I add the new amount for the existing balance. Adding to this. Great. So the revenue becomes 140. So this transaction shows how the business records revenue even when the customer has not paid yet. The company recognizes revenue because the service was performed, and it records accounts receivable for the amount that will be collected later. In our case, after 6 weeks. So identifying the 6th transaction before recording accounting entry. Here, the business borrows 100 loot from Troll Bank. Yeah. So they get 100 loot from this Troll Bank because the company receives cash. The cash asset increases. But the company now has an obligation to repay. It's a deal where they would lend you things for fee, and so fee would be 10 loots every 3 months until they repay, right? Payable whenever Grognets had the money. Great. This obligation creates a liability called loan payable. Again, the company receives cash and at the same time records a liability. Recording the journal entry for the 6th transaction. Here, the business borrows 100 loot from the Troll Bank. receiving in cash. So due to the company's reception of cash, the cash account increases, right? Obviously, cash again is an asset. An assets increase with debits. So I debit cash for 100. While having a loan payable. So it's an obligation, right? Company has an obligation to repay the loan in the future, creating a loan payable. Which is also 100. Liabilities increase with credit. So let's post the debit portion of the 6th transaction to the ledger. The journal entry shows a debit of 100, right, in cash. Because the cash account already has previous debits from earlier transactions. Again, what do? We combine them again with 100. Yeah, having 340. Next, we've got portion of the transaction again. When having loan payable, so we've got this part, right? Showing the credit column, we're putting our loan. Great. Representing the company's obligation to repay the borrowed money. So because liabilities increase with credits, I recorded this amount, 100. On the side of credit of the loan payable. This transaction records the borrowing of money from the bank, right? The business receives cash, which increases assets, and at the same time records a liability. So because the loan must be repaid in the future. So identifying the 7th transaction. In this transaction, business obtains items from the crypt, right? So they got items worth 200 loot. So 200 loot of weapons, armor, and gems entered. There's firm's inventory. These items are resources that the company now owns and can use or sell in the future. So because these goods are held by the company as the resource, they're recorded as inventory. And inventory is an asset account that represents goods owned by business. So the company increases its inventory assets by 200. Now I record the journal entry for the 7th transaction. The company obtains goods from the crypt that have a value of 200 loot. So we've got as inventory now 200. These goods are resources owned by the business and will be used or sold later. So they're recorded as inventory. Inventory is an asset account, and assets increase with debits. So a debit debited this inventory for 200. Because the company gains economic value from these goods, revenue is recognized. Again, we've got this revenue part. So revenue increases equity, right? And equity increases with credits. So credit revenue for 200. Great. Now post the debit portion for of the seventh transaction to the ledger. Journal entry shows 200 for inventory. Here we've got nothing, and let's put them together. Great. So inventory is an asset account, and assets increase with debits. Recording on 200 on the debit side would be appropriate. Next, we have credit portion, right? Credit portion of revenue. Interestingly, let's put them together too. The journal entry shows an additional credit of 200 of revenue. Revenue already had a credit balance from earlier transactions, right? So for that reason, yeah, we're adding them together again. Let me add. Great. So the revenue count is now a total of 340. Identifying the next transaction before recording it. So we're on the 8th transaction. After the crypt job, the firm recovered 200 loot worth of goods. Yeah, and according to the warband compensation agreement, the warband receives 30% of the loot generated from each job. So was due 30%, and 30% of 200 loot equals 60 loot, as they said here, right? 60 loot, 30% of the 200 loot. This amount is paid to the warband members for the work they performed during the crypt job. For Mock, Duck, Rank, and Basha. These represent the cost of services required to make the firm's revenue. Thus, the business records a wages expense and reduces cash. Recording the journal entry for the warband payment. This all explains that the warband receives 30% of the 200 loot recovered from the crypt. Right, this 30% of 200 equals 60 loot. The payment represents the labor costs required to generate the firm's revenue from the crypt job. And having wages expense. Because it's a cost of services, it's recorded as wages expense, yeah. I've got 60. Expenses increase with debits, so I debit them in this amount. The payment is made in cash, which reduces the company's cash asset. So we got cash again. Assets decrease with credit, so I credit cash for again 60. Now I post the debit portion of the transaction to the ledger. And so the journal entry shows a debit of 60 to wages expenses, right? So as long as we don't have anything here, we add them this way. Wages expenses represent the labor costs paid to the verbant for completing the crypt job. So expenses increase with debits, making us this on the account side. Next, posting the credit portion of the transaction. The journal entry shows a credit of 6 to the cash, right? Cash is an asset account, and when an asset decreases, it is recorded with a credit. Since the company is paid the verbant 60 loot, the cash balance decreased by 60. So it should have decreased by 60. Great. So now we've got the next introduction, which is 9s, before recording the journal entry. So after the crypt job, the firm sells some of the weapons and the armor from the inventory. Dwarf arms dealer named Hildrum, Iron Forge. Hildrum Iron Forge purchases these items for 90 loot. So for goods that had cost the firm nothing to acquire, they were part of 200 loot of revenue already recognized, right? These goods were already recognized, so therefore this transaction doesn't create a new revenue. Instead, it simply converts one asset into another asset. Inventory decreased and cash increases. So I record the journal entry for the arms deal, which is 9's transaction. The firm sells weapons and armor from the crypt inventory to Hildrum Iron Forge for an idle loot. And so, because the company receives cash, the cash asset increases. Again, we've got here some cash by 90, right? At the same time, the goods are no longer owned by the company, so inventory decreased. Inventory decreases. Great. So it decreases by 90 too. This transaction doesn't create a new revenue simply because its revenue from the crypt hole was already recognized earlier. So posting the debit portion of the arms deal to the ledger. The journal entry shows 90 to cash, which means all adding again this new loot with our cash, right? So our asset account increases since the firm received 90 loot from selling the weapons. The cash amount increases by 90. Next, I'm posting the credit portion of the transaction. The journal entry shows a credit of 90 to inventory, right? So just like this one, we'll put in here our data, having 90 at the credit of an inventory. So inventory is an asset account, and when asset decrease, it is recorded with a credit because the weapons were sold. the firm's inventory decreases by 90. Now I identify the next transaction before recording the accounting entry again. During the crypt job, the firm obtained a spell book that was recognized in inventory with a value of 0. So later, the spellbook is exchanged with a wizard named Tefrin. So for search letter, search letter that costed them 30 loot at the market rate, right? What else? The letter has a market value of 30 loot, and again, due to the firm's receiving an asset worth 30 loot while giving up an asset valued at 0, the company experiences a gain. So as it's named here, the difference 30 loot. The letter enters inventory at 30 loot, and the difference between the assets is recognized as income. So it's just a free income sort of. So the next journal entry for the spellbook trade. The company exchanges spellbook from inventory for a siege letter with a market value of 30 loot, right? So we gain now the inventory. Which is a 30 loot. The spellbook had been carried in inventory at 0 value because it was part of the crypt whole and was not separately valued. The company now receives a letter worth 30 loot, which becomes part of the firm's inventory. Inventory is an asset, and assets increase with debits. So debit inventory for 30. Again, let it be gain on exchange. Gains increase equally and are recorded with credits. Right. Therefore, we've got gain at 30, and yes. Now I post the debit portion of the spellbook trade to the ledger. The journal entry shows a bit of 30 to inventory, which we're adding just like always. Putting plus here. Great. Making it 230. So inventory is an asset account, and assets increase with debits. Recording the 30 as a debit, we're having 230. Next, we've got credit portion on the transaction. What we got here, yeah, the journal entry shows a credit to 30 to gain on exchange. The company received an asset worth 30 loot while giving up an asset recorded as 0 value. So if it's of 0 value, what do? We go to appropriate cell of it, get an exchange on credit. And we, as always, putting the same numbers. So while giving up an asset recorded at 0 value, it received a loot. So difference represents a gain which increase equality. Equity. Gains increase equity and are recorded with credits. So recording will be our part of the process. Sorry. So now we identify the next transaction before anything else. The firm enters a protection agreement with a village of Millhaven. Here it is. The contract specifies 30 loot for protection. Receivable from Millhaven for months. One of protection services. So the services begin immediately, so the revenue is earned. But the company has not yet received the cash, because the firm now has the right to collect payment in the future. Their services commenced, contract signed, obligation undertaken, even if this requirement is aligned. It records in accounts receivable. So the company recognizes revenue and records a receivable from Millhaven. Now I will record the journal entry for the Millhaven protection agreement. The company provides protection services to village to Millhaven for 30 loot, right? which is great. And it goes to accounts receivable. The services begin immediately, so the company earns revenue. But the cash is not received, as we stated. So we're gonna collect it over time in the future. Accounts receivable is an asset, and assets increase with debits. Revenue increases equity and is recorded with credits. So we've got another revenue. So here we had 30. Here we have another 30. Posting the debit portion to the ledger. The journal entry shows, just like always, 30. A debit of 30 to accounts receivable. Accounts receivable represents money, right? Owed to the company by customer. Because the firm now has the right to collect 30 loot from Millhaven. We're adding to this part the beautiful number. Great. So now we have 90 here. Next, what we do, so assets increase with debits. We've got this number. Now what we do, we look at our journal entries again, not seeing here our credits from revenue, and again we're adding to this thing another additional revenue, which is 30, right? Great. So our revenue increased to 370. So identifying the next transaction before recognizing the accounting entry. Earlier, the firm recognized a receivable of 30 loot from the village of Millhaven for protection services, right? Millhaven, this gentleman suggested his protection services for a certain amount. To be precise, for 30 loot. So, however, the situation changes when a paladin intervenes. So, paladin intervention had voided the contract in 3 territories, and the maid had no money anyway. So the loot of receivable from Millhaven should be, but it's uncoverable. So as a result, the company is no longer able to collect the 30 loot that was previously recorded as accounts receivable because the receivable is not uncollectible. The company must remove the receivable and recognize a bad debt expense. Yeah, as they said, bad debt. The asset is gone. A bad debt. Gregnet started at the ledger for a long time. The asset had to go, wrote off, receivable removed, loss recognized. It's gone. Everything is bad. Equity reduced to 30 loot. So this represents a loss from an account that cannot be collected. Now I record the journal entry for the Millhaven bad debt. So earlier the company recorded the receivable of 30 loot from Millhaven for protection services, right? But after the company is no longer able to collect this amount, because the receivable is uncollectible. It's uncollectible. The company must remove it from the accounts and recognize the loss. So for new transaction, we mark this bad debt. So more exactly, bad debt expense, right? So it's sorry. Expenses increase with debit, so so we debit it this way. At the same time, we've got account receivable asset, which must be removed. Yeah. Or again, it goes as 30. Again, journal entry shows us 30 at the bad debt expense, and we transfer the same amount to this place, this way. Great, we've got it here, and the term of accounts receivable. We do the same thing with accounts receivable that need to be done. So it's the second month of operations. It's all about merchant guild and his prepayment. When the revenue is recognized, so revenue balance was recognized as early income. Identify the next transaction before recording the accounting entry. Again, at the time the amount was recorded as deferred revenue. So earlier in the case, the merchant guild paid 120 loot upfront for 3 months of protection services. Yeah, just like I said, at the time the amount was recorded as deferred revenue because the services hadn't yet been delivered, meaning no now now 1 month of service has passed because part of the obligation has been fulfilled. The company can recognize a portion of the deferred revenue as earned revenue. So the total contract was 120 loot for 3 months, which means 40 loot of revenue is recognized each month. This transaction reduces the deferred revenue liability and recognizes 40 loot of revenue. Now, recording the journal entry again for the merchant guild revenue recognition. As we stated earlier, the company received 120 loot in advance for 3 months of production services. At the time, the amount was recorded as deferred revenue because the services had not been delivered. Let's write it to our new transaction. Revenue, which is 40. So now 1 month of the service period has passed. To determine the amount of revenue to recognize, we divide the total payment to 120 loot by 3 months, which gives us 40 per month. Because the company has now delivered 1 month of service, 40 loot of revenue is recognized. Deferred revenue is a liability, and liabilities decreases with debits. Revenue increases equity, and it's recorded with credits. Again, making revenue 22 credits. We'll mark it as 40. So what we do, as always, the journal entry shows a debit of 40 to deferred revenue. As always, we add, right? Let's add this way. We get 40. So deferred revenue represents a liability because the company received payment in advance for services not yet delivered. So part of that obligation is fulfilled because 1 month of service has been completed. Liabilities decrease with debits. Next, we go with revenue. We have it in the credit part. So credit part of the revenue is here. Adding this amount would be a right choice. So we have 410 for credit part. Because service has been provided, 40 loot of revenue is recognized. Revenue increased equity, and it's recorded with credits. Next, I record an impairment adjustment for the client list. The client list was originally recorded as an intangible asset valued at 80 loot. However, several villages have stopped paying, so the asset's recoverable value is now estimated for 45 loot. So the difference between the original value and new value is 35 loot. This decrease in value is recorded as an impairment loss. We will have in our transaction. Impairment loss, which is 35. We've got another one. Impairment loss is an expense and indicates with a debt. Increases with a debt. The intangible asset must be reduced. So it's credited for 35 to it. Great. So we'll put the same numbers, just like always. impairment loss. From here, the same goes to intangible asset, credit part. Here we go, and we go on. We go on with the next one, which is interest accrual. So next, what do I pay attention to? It's just our record, the interest expense on the Troll Bank loan. The company borrowed 100 loot from the Troll Bank, 10% quarterly interest, as you remember. So 10% of 100 equals 10 loot of interest, right? What we have in our transaction. Interest expense, which is 10, and we've got credit, of course, which is interest. So by the way, even though the interest has not yet been paid, accounting requires that the expenses be recorded when it's incurred. So interest expense increased with a debit. Interest payable represents the obligation to pay the interest and increases with a credit. We have 10. Going to the T account, just like always, interest expense standing at 10, and our interest payable standing at 10 too. So also I record depreciation on the word drum. So the drum costs 45 loot and has an estimated useful life of 2 years, right? So 2 years equals 24 months. Dividing 45 by 24 gives approximately 2 loot of depreciation per month. Depreciation expense records the portion of the assets cost used during that period. So for this, our transaction will be using depreciation expense, which is 2, and credit as accumulated depreciation, which is also 2. So accumulated depreciation records the reduction in the book value of the asset. Therefore, I debit depreciation expense for 2 and credit accumulated depreciation for 1. I mean 2. Let's add our values to T account. So we've got 2 at the depreciation expense. We can do this way. And we've got 2 at the accumulated depreciation. So the next company makes a partial repayment of the Troll Bank loan. The payment includes 50 loot of loan, principal, and 10 loot of interest. So we've got in this transaction loan payable, which which is 50, and interest payable, which is 10. Loan payable decreases because part of the debt is repaid, right? And the interest payable also decreases because the previously accrued interest is now settled. So the company pays a total of 60 loot in cash. And as always, we will transfer it all to our ledge T account. Loan payable, we've got it here. Also we've got interest payable, which is 10. And we have credit for cash, right? Um, 60 plus, making it 120. Finally, the company pays Sneak's salary. So the the salary had previously been recorded as a liability, right? And we got here salary payable. Payable, yeah, which is 15. Good. And now the payment is made. The salary payable account decreases. Cash decreases because the company pays 15 loot. Again, we have cash. Great, and as always, transferring to the T account. What I'll have here, it seems to me, salary payable. We'll make it 15, and so we add credit on cash. Wait, I'm adding to this 15, 135. Yeah, that's right. So after recording all transactions and adjustments, all journal entries have been posted to the ledger, and accounting records for the period are completed. We can make, as always, certain adjustments here and there. Center, format is stable. Yeah, let's make it look like something more appealing if we can. Putting certain rows here and there, right? 6 boxers. I was just mentioning this part. Doesn't look bad. Thank you so much for all your attention. Follow for more.